Peter Rose, Longwood Currency Trading. Good afternoon. It's a beautiful early August of 2021. Thought it was going to rain this afternoon, and it would be chilly. It's been chilly most of the day. I got to go out and walk Bodog, but I just took him out for a walk the last couple of videos that I've done. So I thought I would talk about a FOREX framework for staging lots, and do that inside before I take him out for a walk. I have my last cup of coffee for the day and see how things go. In a one of the previous videos that I did, actually it was about a year ago, a little over a year ago, I did a video on rethinking my thoughts on staging out of a position. And in several of the videos I've said that, well, I would stage out, but I wouldn't stage in. And then not long ago I started working a computer simulation model I've told you about for staging lots in. So where do I stand on all this stuff? Well, look, the channel is primarily for someone who has a little bit of experience in trading and hasn't had a whole lot of the success that they thought they were supposed to be able to have, and they look at it and they say, I should be able to make this work. How do I rethink about this? Because the education that's out there is generally not providing those solutions for you the way that you had expected that an education would. It's not for the really experienced trader, unless you've fallen flat and wiped yourself out a couple of times. You go, whoa, wait, I need some rules here. But it's definitely not for someone who hasn't pulled the trigger and executed a trade yet. And so a lot of what I say, I think, is understood by the group that I'm targeting it for, because there's some experience level in there. And so, I mean, it's like somebody talking about, I don't know, sailing a boat, and you're teaching sailing. Well, there's some really basic things to do. Let's say you're sailing a sloop, so you've got that jib, that little sail that's up in the front. Well, you know, if you're teaching people that have a little bit of experience, maybe this is lesson 8 or something, you can say, you know, if you have a little too much wind, you could put this jib sail up, but and reef it. Or even if it's really bad, you could go to put a storm sail up, storm jib. And the person learning that would say, well, yeah, if I needed it, but I'm not either not good enough yet to worry about sailing when it's bad, or I don't like to sail when it's that rough, or they're going to say, yeah, but more important than that would be some other aspects of sailing in order to get the technique down, to maximize the wind capability of the sails in moving the boat forward. Talking about a storm sail is a subsidiary topic. So you could say, as an instructor, well, I'm not going to show you, I'm not going to talk about storm jibs, because it's really not applicable. And then 3 classes later say, you know, it looks like the wind is going to pick up a little bit further, so if we were out in the harbor a little bit more, and it really starts to blow, you know, we'll put up this storm sail, and I'll show you what the thinking on that is. But we don't want to stay out there too long on that, because, you know, there's no point in getting into danger, because that's taking, yeah, it's a lot of fun, but it's you know, the water's a little cold, and you have things to do after sailing class, and so we won't do that. That's all understood. But I think as an educator, for those of you who don't have a lot of experience, the whole idea of the channel is not to cloud your view of stuff that you could do, but stuff that you should do. And to limit your scope of things to concern yourself with so that you're not distracted by the real things that you need to do and learn in order to learn how to trade. Putting on a storm sail is ancillary to learning how to sail and to learning how to sail well. You'd only put a storm sail up if you were planning on being way outside the breakwater and doing XYZ. Well, you know, maybe staging in and out of lots you'd probably only do if you were a long-term trader. Is it practical at the short-term trading level, you know, a day trader level, to stage in and out of lots? No, not unless you have a lot of experience, and you're not going to get your roids in a flare over putting more lots on or pulling lots off and losing potential on those lots as the price moves in your direction, and you're clipping yourself on your reward to risk and all that other kind of crap that we go through. So I think it's a lot easier simply to say, well, let's take the whole concept of staging in or out off the table so we can concentrate on the real stuff that constitutes trading. So you have to understand that a lot of the things that I say, for example, indicators in general, you don't use indicators ever for a trade entry because they don't make any sense. You can use them a little bit for trade management, but all this stuff about confluence, I've been over this stuff before, and I think everybody understands what an indicator is good, what an indicator is, and when it could be applied because of what it is. But I think in talking about staging in and staging out, you see a lot of examples on videos and certainly in the educational process for this whole staging process. It has its place, but one of the main requirements of staging is that you you stage with multiple lots. So if you're not very good, you shouldn't be trading with multiple lots, because why lose 3x when you're learning when you could lose 0.5x? You know what I'm saying? So in most of the examples that I give when I'm talking about trading, I use $1,000 bank trade in one mini lot at $1 a point. Well, and I don't advocate micro lots. If you can't come to the table with $1,000, stay home. You should not trade micro lots. You see a lot of people trading micro lots, and if you're trading micro lots and you're really experienced, you're using you're risking 5 to 8% of your account in order to make that thing grow, and you're compounding. You're doing all the stuff that I say you shouldn't do, and they will say, if they're good, they will say that. You go to Gary Langley's channel, Langers, the scruffy trader out of the UK, and he stages all the time, and he's even got an account now with a prop firm, and he just trades 50p. You know, that's it's. And he does really well, but he will say, you know, I'm taking 4 or 5% risk. Well, my whole process is I don't want to do anything different trading 10 lots than I would if I was trading 1 lot or a micro lot, because I don't want to. Trading is so simple. Why complicate it when you don't have to? What's the point of trading? You want to make a lot of money. You can't make a lot of money. You cannot make a lot of money with a little money. You're not going to take a $10,000 account to $100,000. You might be able to do that in 10 years or 5 years or something like that. Or if you're really good, maybe a couple of years. You may get two. I mean, you get 20 to 30% a year. It's going to take you 3 years to double that account, but you got to take your taxes out. It'll probably take you 4 years. Come on, let's look realistic here. So if you want to make $60,000 a year, what level of money? Let's say 20% of some number is 60,000. I don't know, what is that? $300,000 account? You're trading 30 lots. It's everything is relative, but what you do trading one mini lot should be the same thing you do if you're trading 5 full lots. And so, in order to keep the discussions of trade entry and all that stuff relative to the trading process itself, you go all in at your entry and you come all out when it's time to go home. Now, once you've got a good win-to-loss ratio, you could say, well, I'm going to try staging out of the position. A good win-to-loss ratio means that you're pretty likely to get to your profit target, whatever that is. So a process of staging out makes sense. You know that that profit target is set somewhere. That's what the environment, the market, is offering you. You know, if I open my refrigerator and I have 3 eggs, I'm not going to be able to cook or bake a cake for 20 people. If I want to bake a cake for 20 people, I got to have more eggs. So when I'm looking at a fairly good win-to-loss ratio, I'm looking at a profit target that is the maximum that I think in my day trading environment I'm going to be able to get in a couple-hour period of time. When you look at a long-term trade, it's basically the same thing. I'm looking at this thing. I think that there's a large institutional campaign going on for, looks like it just started. This thing could go on for a few weeks. I'll shoot for 300 pips. 300 pips is, I mean, you're out to that second decimal point, so instead of 1.41, you're going to 1.42 if you go for 100 pips, let's say. So that's not changing the ultimate price too much. You got to remember that the institutions are trading billions of dollars, and they can't have the price of $3 billion worth of car parts. You know, maybe $1 billion of those car parts is going out at the equivalent of US $1.40, and another $1 billion is going out at $1.50. You know, yeah, it's only 10-cent difference, but 10 cents over 1 million units could be a lot, right? So that's why when you're looking at the currency markets, a pip is 100,000th of a dollar. So you're way out in what that market is going to allow price to go to, and that's why you have these chop zones. The prices gets to a point where it's just crazy. The guy that's running the campaign says, I'm not going to pay any more for that than this. The client won't let me pay that, and he's got to bring the price down to a reasonable level to where he thinks he can pick up a bunch of more stuff, which might be 30 pips down or 50 pips down. Because you get all these idiot retail traders out there that are taking 50 pip risks. So you bring it down 50 pips, flip it around, run it back up 50 pips. Why do you think this stuff repeats? It's because that guy's got $3 or $4, $5, $6 billion to unload into the market over a 4-day period of time, or a 3-week period of time. And the economy is constraining him. I'll pay $1.40. I'll pay $1.43 or 45. You know, so your price is going to be jamming back and forth in there in that channel until that campaign is done. So when do you know that it's in that channel? Maybe that channel is in a trend channel that you're going. It's a zone or whatever. So the rational thing to do trading a mini lot is all you've got is the one thing to go in, and then all you've got when it's in is one, and so you pull it off at the profit target. Okay, so in generally speaking terms, my advice therefore has always been judge your entry as well as what your potential price management is going to be based on all in, all out, because that simplifies your analysis. If all of a sudden you're going to jump into staging issues, you go off into a spaghetti of choices, and you don't want to have choices when you trade. It's either a good trade, or it's either going to be a good trade, it's going to be a bad trade. It's either going to make you money or it's not going to make you money. And in that case, it could be a bad trade because you're making the wrong decision to go in. If you don't have enough confidence that you could be all in, all out, then you damn sure shouldn't be farting around with your clipping yourself on reward by staging out, or compounding the problem by stacking more lots onto a position that could flip around on you and go 30 pips against you, hit your stops, and take you out into catastrophic loss as you've averaged into the thing. So let's look at this as a framework. Your standard trading framework is all in, all out. Now, if you want to stage either in or out, you have to therefore do it with multiple lots. My advice is don't even think about the staging process unless you've got 5 of whatever it is that you're going to trade. Either you're trading 5 minis, 5 full lots, or 50 lots. You got to go and have 5 of them, 5 groups of this stuff to do this. Why? Because most of the time, you're not going to get to your profit target point, which is where you're either pulling stuff off to get to or adding stuff in. So that doesn't necessarily mean that you're going to trade 5 minis. It doesn't mean that you're going in with the intent, you're going in with 2 and you're going to add 3 on the way up. What it means is, this is on scaling in, it means you go in with 1, let's make it easy. You get to some level, maybe it's, if your profit target's 20 pips away, then you go in at 5 pips maybe and throw another lot in there. Now you're at 2, and you wait 10 more pips and you throw another one in. There's 3, and then you sit there because you don't want to add another one and it bumps into a resistance zone at your profit target and pulls back, and then you lose that. See? So you've just done 3 lots of the 5 that you have available to you because you're within some range of your profit target. Now that's a whole other discussion in itself as to how close you want to get to that profit target without staging in another lot. If you get to the profit target and things look good, then you can take another one of your remaining 2 lots and add that. And then if it continues to go, you add that. And if it continues to go beyond that, you write a check, put some more money into your account, and go all in, and keep staging. But you initially have a bank of 5 that you're willing to commit. The plan is to commit 3 and then make the decision to do the other 2 later. If you're talking about staging out, that means you have to have a lot in the beginning in order to pull them out as you go. So you would take, I mean, if you're trading, if your process is to trade with 5 again, then when you go into entry, you put 3 up, and then when it gets to, let's say, 5 pips, you pull 1 off. It gets to 10 pips, you pull another one off, and it gets to the profit target, you pull the last one off, or you let it run. Because you can always trail a stop behind that last one, and you may lose a little bit of whatever it progressed through, but you're getting value for your dollar as you pull them off. But you never got to their full 5 lot containment if you do that. Because if you put the 3 in to start and it goes against you, you're losing 3. So now you go back into the bar and you put the 3 up and you lose again. Now you lose 3 again. Now you go up and it starts to win. You pull 1 off and you only have 2 that are going a little, and you pull 1 of those. You see the problem? It's really a problem. Because when you front load heavily in order to pull off, it's very difficult to make up the losses on the numbers of times that you lose. I've done computer simulations on this. It's very, very difficult. And so what happens is part of the framework that you're building has to consist of a mix of staging in and staging out as you go. So one of the things that I've been experimenting with is, again, looking at that 5 potential lots that I want to trade. I go in with 2. At 5 pips, I pull 1 off. At 10 pips, I add another one, so now I'm back to 2. At 15 pips, I add another one, and I keep adding until I've gone and done my 5. But I can always, as price comes around at me, get out, and I've at least got a 5 pip winner because I pulled that 5 pip off because I'm trailing the stop behind me. And if I get stopped out initially, it's only on 2 lots. So because if you have a good win-to-loss ratio, you're able to get over that 5 pip point, so you're locking at least those 5 pips in early. And even if things roll over, if you just made 3 winners with the 5 pips, you'd have 15, and you lose twice or 3 times 5 pips, you'd be at 15, you'd be jump ball. So at least if things weren't going quite well for you in that particular run of the series of trades, you'd be jump ball on it. But when the things really start to go and you're staging in and trailing the stop and getting that extra value for the pips that are going, when that thing develops the momentum to carry it further, now you're able to really maximize the gain on that position, and you haven't taken too much toss-away risk at the beginning. But you can see that takes a lot of experience to do that. Why would I get on a YouTube channel and purport that stuff? Because that's exactly the kind of thing that I'm against, because you guys are going to start experimenting with pull-off and put-on theory. And it's not practical for you. Look, if you can't play with one mini lot, all in, all out, and be consistent and win between 5 and 10 pips averaged out over every trade you make. In other words, if you make 10 trades and you have 5 winners and 5 losers, so you're 50-50 jump ball, then over those 10 trades you need to have won enough such that each trade is worth 5 pips in profit. So over the 10 trades you'd have to make $50. So or 50 pips, sorry. $50 on a minute, let's say, or a full. So if you can't do that, you simply do not have the skill to pull on, push off, or push on, pull off. You don't. The idea behind an educational pursuit is to be educated to get you to the point where you're good enough at this basic framework. And if you build a really strong framework, you can then add to it. But if you have a shitty fragmented framework, when you build onto it, everything's going to fall to shit. It's like building a house. Look at the nature around you. Trees. If you have a crappy root system and you get just a moderate wind, it's going to knock that tree over. And this gets back to what I've been talking about the past month or so on this videos on process-oriented trading. The framework of your basic methodology forms the framework of your process, not only in the stuff that you do, but in the manner in which you do it, which is the how. You get the what and the how and the when. And so if you become successful for that framework should be, as we say in software engineering, extensible. In other words, you should be able to build on it and extend it. If I build a framework for a double-wide mobile home or manufactured home, that's it. It's not extensible. You're not going to be able to put a second floor on that because the walls that you put up are only designed for a single-story dwelling. I had an issue with that in a piece of real estate that I own. We were talking about air rights and building up. It was a single-story building, and all the buildings around it were 4 stories. And so, well, what would it take in order to add and build up on top? And the engineer came back and said, well, you put 1 story on it, and it's going to cost you X amount of money. And then you look at that additional 1 story and you capitalize that value out, and by the time you got done adding that money in and then selling it, you would sell it and barely make any money for the risk that you'd have to take. So the idea was, well, you have to go up to match the surrounding buildings, which would be 4 stories. Well, now the infrastructure isn't there. So you're going to spend probably $400,000 just to rebuild the existing structure that you have so that it's strong enough to support the 4 more. And now you can add the 4 more. But when you get ready to sell those off as individual residential condos at $500,000 a piece, now you're talking some shit, or 400,000 or whatever. And the last building I sold, it was a small commercial thing, but the residential units right down the street, they're going for $700,000. It was craziness. It was craziness. I don't want to get involved in that. I'm out. Let somebody else knock this down and put 4 stories up and have a $6 million project and come out of it with $7 million. That's great. So you have to look at your trading capabilities. You got to look at the amount of dry powder you've got, what size of a bank you've got, all those things. But why worry about all that shit until you have a big bank? Why worry about the problems or the opportunities that you'll have with a $100,000 account when you're trying to get this stuff squared away on $1,000 account. I mean, if you're working with me, it's $1,000. I'm not going to work with you if you have a $10,000 or $20,000 account. Why the hell would I? Because you don't know what you're doing. You're going to lose the $20,000. You're going to blame me. It's not worth it. You got to learn it the right way. You got to build your framework, and you got to go from there. So there are things that we don't want to have to worry about. We don't have to consider. But that doesn't mean that you won't do them when you become successful. If you're diving off, you're learning how to dive in a swimming pool off the little springboard that they have, why are you worrying about going, I don't know how far in the air, 30 feet in the air to do a high dive? Well, it's not even in your, it's not even going to come into the picture for a few years. Because you barely know how to swim, let alone dive. This stuff takes time. The more you rush it in the beginning, the less likely you are to be a success later. You're compounding your knowledge, and that takes time. So in analyzing the framework for a push and pull off staging, theoretical adjunct to that basic framework, is going to take a lot of time. Not only to develop the skill for, but to build that initial framework correctly. So if you look at my channel, if you go back and look over the body of my work on the video channel, as well as longwoodcurrencytrading.com, on the blogs that I write, it's all foundationing stuff which provides extensibility. And I'll hint at what that extensibility is, but I can't tell you on a video when you're ready to do that. I'd have to work with you over a long period of time in order to be able to help you make that decision. So in the process of where I say, well, I'm rethinking my staging in or staging out or whatever, I'm rethinking it because I've already got the framework built. And even sometimes I shouldn't be worrying about it, because I can be really successful just all in, all out with the process that I have. The reason that you go into these push-pull methodologies later on is to replicate the same basic stuff that you're doing, except magnify that by trading with more lots and by bringing into the power of push-pull, so that you can increase the amount of whatever would be your dry powder, which you've held in reserve, so that if things go wrong, you only lose a small amount, so that when you do find yourself in a situation where this stuff is possible, boom, you can implement that. You know, there's nothing that says if you're going to stage in that you have to stage them all in at that entry-level point. I've worked on scenarios where you go in with one, and then you stage in 3 or 4 right away after the move proves itself out. Because how many times have we gone in to a position and it's flipped around and gone against us? Well, how far did it go in your favor before it flipped around? As a day trader, it goes maybe 5 or 8 points, and it starts to develop characteristics of stagnation. Well, I'd rather be sitting at that point with 1 lot than 3. So I'll let the 1 go against me. Now it's going to go from wherever it's at down to, hopefully it won't hit my stop, because my stop is short. I'm going to turn around and it starts to come back, goes back up to where it was, and now it starts to go beyond that. Boom, I'll drop 3 more in. Now I've got 4 of the 5 that I would stage in. Now I can start pulling them off as they go. But because I've gone through that massive pain in the ass entry, you know, that entry level is so critical to learn how to do. Why would you complicate that by thinking about pulling off or pushing on? You're just lucky to get a good entry. And if you could get a good entry and average 8 or 10 pips, and you could do that 3 days a week, 10 pips 3 days a week is 30 pips. So that's $30 on a $1,000 account. Right? Say you make 30 bucks a month. That's $300 on 1,000 a year. That's 30% on your account, just on minimal single entry push, all in, all out. Why complicate it? Because you're going to lose. So please, as you listen to the videos as they go through, understand that all of this stuff, when it's presented correctly, the educational process itself is a process describing a process. And that process is based on frameworks that are extensible. Thanks for watching, and I hope that if you have any questions about this, look back over the videos so you can kind of pick up the pieces, or send me an email, and I'll be happy to get back to you and point maybe to some of the videos that would help you out in your specific question. But be sure you tell me a little bit about yourself, your age, and how long you've been trading, and where you live, and that sort of thing, because how I would answer, as I've said many times, a 24-year-old's question is going to be different than how I would respond to a 54-year-old's question. Or if you're trading in the United States, where you've got 50 to 1 leverage, as opposed to someone who's in Cyprus and you're getting 200 to 1 leverage. By the way, if you're trading with 200 to 1 leverage, please do not contact me by email or leave a shitty comment, because you don't know what you're doing anyway, and you're going to lose your money, and I can't help you. I'm sorry about that, but that's just the way it goes. You don't have a good framework. You're not doing this correctly. Look at realistically at this concept of framework and process that I've been talking about, and don't get wrapped around the axle about staging in and staging out, and averaging in or averaging out, all that other kind of stuff, because you can do that, but you have to be in a different mindset and a different level in order to do that. Okay, I want you to be safe. I want you to be safe. I want you to have a good time so that you're successful in your trading. Wouldn't it be great if you could be successful and replace your day job money? Or if you're at the older age group, you're 50 or 55, say, look, I hate my job. I just can't stand it, but I'm gonna stick it out. But I'm not making very much money. I'm making $40,000 or $50,000 a year, and I haven't been able to save enough for my retirement. Develop these skills so that you can, instead of putting $100,000 into mutual funds, you'd have a $100,000 account and you trade 10 full lots. But you don't want to do that if you don't know what you're doing. Have a good time with this stuff. It's great. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.